Hello and welcome to Daily Nexus Update, Daily News Brief. Today is Monday, 22nd June 2026. Today's briefing covers 5 stories across geopolitics, finance, tech, crypto. Let's get into it. First stop, geopolitics. Next, geopolitics, where every sentence has footnotes and consequences. The European Commission has officially entered the final round of negotiations for the long-debated EU-Mercosur trade agreement. Following our recent coverage on the bloc's push for secure raw materials, like the lithium projects launched with Norway, this deal is now a central pillar of Europe's green transition. Officials hope to lock in reliable access to critical resources from South America, yet the path forward remains incredibly rocky. European farmers are staging widespread protests, fearing that cheaper imports will undercut their livelihoods and ignore strict environmental standards. This tension highlights the difficult balancing act between securing the materials needed for a sustainable future and protecting the interests of local producers. Negotiators must now find a way to bridge this divide before the clock runs out on these high-stakes talks. The European Union is moving toward a true digital Schengen for public services. The Council has officially approved a new framework allowing citizens to use a single digital identity across all member states. This initiative is designed to cut through the red tape that often slows down people working or traveling across borders, making it much easier to access government services regardless of where you are. This development serves as a key follow-up to our recent coverage on the European Central Bank's digital euro pilot. While that project focuses on financial transactions, this digital identity initiative aims to streamline the administrative side of European life. By creating a unified, secure way to verify your identity online, the EU is taking a major step toward a more seamless, integrated digital future. Quick pivot from geopolitics to finance. Time to check the markets, where charts can move faster than coffee cools. The European Investment Bank is pivoting toward a cleaner industrial future. Following their recent semiconductor investment, the bank has just unveiled a massive €10 billion fund dedicated to building cross-border hydrogen pipelines. This initiative aims to help European industries move away from their heavy reliance on imported fossil fuels. By investing in this green hydrogen, fuel produced using renewable energy, the bank is taking a major step toward meeting the ambitious 2030 energy grid targets. This move complements our recent coverage of the European Central Bank's digital currency expansion, as both efforts signal a broader push to modernize the continent's core infrastructure. It is a significant financial commitment designed to secure long-term energy independence. These pipelines will serve as the backbone for a sustainable, homegrown power supply across Europe. Quick pivot from finance to tech. From microchips to macro consequences, tech never really does quiet mode. The European Parliament is tightening its grip on artificial intelligence following a recent probe into market manipulation. Building on our previous coverage of the EU's ongoing AI liability discussions, lawmakers have now introduced much stricter rules for developers. This update ensures that firms are held legally accountable for any algorithmic errors that trigger systemic financial instability across European markets. Essentially, if a company's software breaks the economy, they pay the price. This move marks a significant shift from earlier, more flexible proposals, signaling a clear intent to prioritize market security over rapid tech deployment. It is a direct response to concerns that automated systems could destabilize trade. Quick pivot from tech to crypto, now to crypto, where volatility still treats calm as a temporary bug. European regulators are tightening the rules on stablecoins to keep your money safer. Following our recent report on the CASP authorization framework, the European Securities and Markets Authority has now released specific technical standards for issuers based in the EU. This is a direct move to protect retail investors from the wild price swings often seen in digital assets by forcing companies to be more responsible. Under these new guidelines, issuers must hold at least 70% of their reserves in high-quality liquid assets denominated in euros. Essentially, this ensures that if a run on a stablecoin occurs, the backing is actually there in stable, accessible cash. It is a major step towards stabilizing the crypto market after recent AI-driven trading experiments. Diplomacy moved carefully today, which is rare enough to deserve a drum roll. If you want the next roundup, subscribe to Daily Nexus Update.